Good day, folks. What I'm going to do in this piece is walk you through, once you have the assumptions and the revenue, where you need to go from there. So the first step, and this is a review because I think it's probably one of the most important things you'll do, we have to make a set of assumptions. You have to make an assumption for every year. That would be 21, 22, 23, 24, and 25. So we make our broad assumptions, and I think if you go back and look at some of our weekly updates, you'll find all the information you need. As a reminder, this one is unique to my company, Steel Dynamics, because of the infrastructure plan. So you have to look at your industry and what's it there. If you're in the retail, is it consumer confidence? Is it consumer spending? So if you're in the retail business, you got to think consumer spending. And if you're in, for example, FedEx, what is the sales? How are sales going to affect that? So consumer spending, but also industrial production. Things to think about there is what's meaningful for your company. If you're looking at an airline company, you're not going to just all of a sudden come back to 2019 levels. You're going to have to come from the 20 level back up, and it'll come in stages. So you need to make a series of assumptions. So that becomes the key part. And as I showed you in the last video, I made mine assumptions of the different business segments, and I did it based on the volume. So when I got all done, when I put it all together, I had my forecasted revenue. I made certain assumptions about the other cost of goods sold, selling, general, administrative, depreciation, etc. And we are going to use a 30% tax rate across the board, 33% tax. We're going to use a tax rate of 33% across the board. Current federal tax rate would be 21, 9% for state and other taxes would get you at just about 30%. We know there's a proposal to go up to 28. I don't think it's going to be 28. I think it's going to be 24. So I tried using different numbers and playing with it, and it really didn't give us a meaningful number. It was just too weird. So essentially, I want you to use 33%. So now that you have all of this, we go on to the, you should have normalized income already. And this is my normalization. And what you can see is I took out asset impairment charges. I broke out depreciation. And that's what I came up with. Now this here, my normalized income, is what comes over to my forecast BAU. Okay? And this is where I'm starting. So I already brought the revenue over from my assumptions page. And I said, okay, the cost of goods is going to be 85%. So I created a formula here. 85% of that will be cost of goods sold. I encourage you to build it as a formula because if we want to change everything, I just want to make it 86%. I just plug it in and everything runs through to do that. You always want to build some formulas around that. So that was the assumptions I made. Now, I also made the assumptions here. Remember, I'm doing this at a really high level. There's my 33% tax rate. And it comes out with my net income. I'm assuming no buybacks. If you want to assume buybacks, that's fine. And that the evidence would be 326 earnings per share. Last year was 348. So it's actually down as some costs are going up, primarily depreciation. And the company is making some major capital expenditures, so we know that'll happen. Okay, so we determine the free cash flow, and as you can tell, it's going to be, they have a lot of capital expenditures coming, and we'll have simple free cash flow. Will be there. We compute the EBIT. I go through the same thing, the bull case, bear case, all of this, and I do my statistical review. And it's interesting is in the first year, you can see that I'm right within, the statistical says it'll be somewhere between 9 and 13.7. So when you see what I calculated, we're in the statistical range. And as we go further out, it's going a little higher, but still not too bad, fairly close to it. But remember, we brought in the Stinton plant and these additional lines, which is a significant increase in capacity. So you really want to make sure you're in a reasonable range, especially in the first 2 years. First 2 years are the most important because then your assumptions are kicking in after that. You then do the discounted cash flow model. It does it all for you. Make sure you put in the tax rate here, net debt, number of shares, and based on this, and we're going to use the instructions will tell you which discount rate to use, and this is the exit multiple. This is all laid out in another video, but that would value the company somewhere, if we're at 12.5%, between $31 and $45. And BAU, when we get up to BAU, it's worth more. Bear, obviously, it's worth less. So that's how you want to take that. On the multiples, I basically went through the peer group. Right now, they're selling at a 1988 PE based on the close on Friday the 16th. And when you value that out, we're getting a range. So this becomes an important, when we summarize it, we can look at it on a business as usual, and we can look at it on a best case and on a summary base. So that's what you need to do. But it all comes back to your assumptions. Any one of these assumptions on my growth off base or my strategic plan implementation, which are these two strategies, will significantly change the numbers. When we're doing valuation, we will come up with different numbers based on our assumptions. So thinking through the estimates, I think, would be a really good way of doing it. So if you have any questions, do let me know. I'm here to review them as you need them. And this is due May 3rd.